The basics of hedging in bank treasury management. Welcome to this video on the basics of hedging in bank treasury management. Hedging is an essential tool for banks to mitigate various types of risks. In this video, we will discuss the key concepts and strategies involved in hedging. What is hedging? Hedging is a risk management strategy used by banks to protect themselves against unfavorable market movements. It involves taking offsetting positions in financial instruments to minimize potential losses. Types of risks. Banks face numerous risks, including interest rate risk, foreign exchange risk, credit risk, and liquidity risk. Hedging helps banks manage these risks effectively. Interest rate hedging. Interest rate hedging is commonly used by banks to protect against fluctuations in interest rates. Banks can use derivatives, such as interest rate swaps or futures contracts, to hedge their interest rate exposure. Foreign exchange hedging. Foreign exchange hedging is crucial for banks that engage in international transactions. By using financial instruments like forward contracts or options, banks can hedge their exposure to foreign currency fluctuations. Credit risk hedging. Banks rely on collateral and credit derivatives to manage credit risk. Collateral helps secure loans, while credit derivatives like credit default swaps provide insurance against potential defaults. Liquidity risk hedging. Liquidity risk refers to the possibility of a bank facing difficulty in meeting its short-term obligations. Banks can hedge liquidity risk by maintaining a diversified portfolio of liquid assets and utilizing funding instruments, such as credit lines. Hedging strategies. Banks employ various hedging strategies to manage risks effectively. 1. Natural hedging. Natural hedging involves matching assets and liabilities with similar characteristics to reduce exposure to risks. For example, matching fixed-rate loans with fixed-rate deposits reduces interest rate risk. 2. Derivatives hedging. Derivatives instruments like futures, options, and swaps are widely used for hedging purposes. Banks can customize derivatives to align with their specific risk profiles. 3. Cross-hedging. Cross-hedging involves hedging risks with instruments that are not an exact match. For example, using an interest rate swap to hedge against a change in the yield curve. 4. Dynamic hedging. Dynamic hedging is an ongoing process where banks continuously adjust their hedges to reflect changes in market conditions. This strategy requires active monitoring and timely adjustments. Benefits of hedging. Effective hedging offers several benefits to banks, including reducing exposure to market risks, enhancing financial stability, protecting against potential losses, increasing confidence among stakeholders, promoting efficient capital allocation. Conclusion. Hedging is an essential tool in bank treasury management. By understanding the types of risks and implementing appropriate hedging strategies, banks can effectively manage their exposure to adverse market conditions. Remember, successful hedging requires careful evaluation, monitoring, and adjustment based on changing market dynamics. Thank you for watching. Want to learn more? Claire Trifle on LinkedIn.